makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and here's what's coming up on today's program. A 4-day pause in fighting between Israel and Hamas begins. 50 Israeli hostages and 150 Palestinian prisoners are due to be released, with more aid allowed into Gaza. Germany again suspends a limit on borrowing amid the country's budget turmoil. The country's economy minister calls for radical reform. Plus, Barclays is reportedly cutting costs by as much as £1 billion with 2,000 jobs on the line. So happy Friday, everyone. There's a lot to get through, a lot of news out there, and we have a really packed show. So let's start with the European markets map. Again, a lot of the focus is on some of the economic picture that's darkening. We're also getting some Ifo pictures or Ifo figures across the board. Now, European shares seem to be wavering. Again, this latest economic data really highlights Germany's struggle to actually recover from an energy-induced downturn last winter, and of course look at the impact of higher borrowing costs. If you look at the stocks Europe 600, pretty much little change, and then treasuries declining after trading resumed following a holiday. So that's the very latest, of course, on some of these figures. The Ifo Business Confidence Index, 87.3 instead of the estimated 87.5. Now, shortly, we'll be speaking to Clemens Fuest. He's the president of the Ifo Institute. A little bit later on in the program, we'll talk budget, we'll talk about the economy and what the fault lines for Germany are. That interview, 9:30 a.m. UK time. Now, switching focus to developments in the Middle East, and a 4-day pause in fighting between Israel and Hamas is underway. Now, it sets the stage for the exchange of dozens of hostages held by militants in Gaza in return for Palestinians imprisoned by Israel. For more, let's get straight to Bloomberg's Sam Dagger. Sam, what's happening on the ground since the truce came into effect, and what can we actually expect?
Thank you, Francine, and good to be with you. Well, the truce seems to be holding so far. We're 5 hours in. The next sort of important thing to look out for is in 4 hours, when we're expecting 13 Israeli hostages held by Hamas, women and children, to be exchanged for 39 prisoners held by Israel, also including women and children and teenagers as young as 14. Obviously, the International Committee of the Red Cross will play a key role in all of this. So far, the truce appears to be holding. Aid has come in through Egypt, food, medicine, fuel, and cooking gas. And we've also seen these incredible images of Palestinians emerging from weeks of hiding, of sheltering, under Israeli bombardment. They're out on the streets, they're looking bedraggled, tired, they're moving around with their meager belongings. Some of them have tried to go back to the north from where Israel had ordered them to evacuate at the beginning of this military operation. But the Israeli army has said nobody should come back north. In fact, it wants to make sure that whoever's left in the north leaves, particularly the wounded at the hospitals. I mean, the situation is dire. I mean, the health authorities in Gaza, the ministry, which is controlled by Hamas, says now the death toll is over 15,000 since October 7th. The wounded, we're talking in the tens of thousands. And the United Nations and Arab states have come out this last night and this morning calling for a permanent ceasefire. They're putting pressure on their Western allies. We had Saudi officials speak to their counterparts in the UK and the US in the past few hours. And then we also have some strong statements from the United Nations. We have the Commissioner General of UNRWA, which is the UN agency, and I'm reading here, responsible for Palestinians in Gaza. He was there last night, and he said, and I quote here, "People are exhausted and are losing hope in humanity. They need respite. They deserve to sleep without being anxious about whether they'll make it through the night." End of quote.
Thank you so much, Sam, for the update. Of course, we continue following, and our heart goes out to everyone on the ground. Sam Dagger there with the very latest from Hamas, Israel. Now, Germany's economy contracted 0.1% in the 3 months to September as the country languishes in what the Bundesbank reckons may be a recession. It comes as Europe's largest economy is set to suspend its borrowing limit for a fourth consecutive year. Joining us now is Paul Donovan, Global Chief Economist at UBS, and Bloomberg's Noor Al-Ali. So thank you both for joining us. Paul, how worried are you about the German economy? And good morning.
Good morning, Fran. Well, I think the German economy is suffering, obviously, from being more dependent on energy coming out of Russia. That's been its first negative. But also the global consumer switch that we've been seeing, where consumers, having had this phenomenal boom in demand for durable goods back in 2021, they've switched to spending on having fun, tourism and Beyonce concert tickets and all that sort of thing. And of course, Germany's exports are, shall we say, biased more towards the goods than the fun side of that equation. So that shift in consumer spending is also something that has a bit of a bearing here. I think it is also important to remember, though, when we get worked up about, is growth negative for 2 quarters, Germany has a falling population. That means that it is more prone to have episodes of negative growth without a fall in living standards. So we do need to put in perspective the demographic issue that Germany is experiencing. And that means, I think, that while Germany is in a weak position, it is not in a dire position.
Noor?
Look, I agree with Paul, right? We had PMI's data that came out yesterday that showed the downturn easing in November. Now, obviously, those PMI figures were still in contractionary territory. We still have that inflation problem. They're in a very much stagflationary environment. But it's not just Germany. It's the euro area as a whole. And it's something that the ECB has to deal with. Policymakers are pushing back on those very dovish bets from money markets, expecting those central banks to cut rates as soon as next year, whereas policymakers are still holding on to that 2% inflation target. And so with those dynamics, I find that volatility in the bond market is still very much going to persist into next year.
Paul, when are you expecting the first cuts from the ECB, but also from the Fed?
So I think the Fed and ECB will be fighting it out as to which gets in first in the late second quarter of next year. I think the Bank of England will actually be the first to cut rates. The Bank of England has an advantage that it's run by a qualified economist and somebody who's prepared to look forwards. I think the problem, and it's frankly a big problem with both the ECB and the Fed, is they keep saying, well, we're data dependent. And the trouble is, as we all know, economic data has become steadily less reliable in recent years. And so you can very easily get a rogue number, and that could delay the rate cut from ECB or the Fed, and then the following month the number is corrected and the central bank ends up looking foolish.
When you look at some of, I guess, the dynamics going forward, Paul, what's the biggest mistake that we could do here in Europe? I know there's different economies and they're quite eclectic and they're difficult to deal with because of the different dynamics. But what does a mistake from the European Central Bank look like now?
Well, I think a concern for me would be that the ECB remains as backward-looking as it is. The whole point about a properly run central bank is you're forwards-looking. You're saying, OK, yes, inflation is above target now, but we know monetary policy operates with long lags. And where is inflation going? And when we look at the composition of inflation, the durable goods price inflation, the transitory inflation of 21, that's long over. There's energy prices, which the ECB can't do anything about. And then we've got the profit-led inflation, which is really now starting to be squeezed. We're seeing pressure on margins. That profit expansion is coming under attack from consumers who are just not willing to accept it. So when you add that together, I think the momentum of inflation continues to be downwards. Won't necessarily be a smooth trajectory, but the direction of travel seems clear. And I think if the ECB ignores that and keeps looking in the rear-view mirror, then it's going to keep interest rates too high for too long.
And Noor, could that also, of course, lead to even more volatility as markets price in something and then have to walk it back?
Absolutely, right? You have seen that push and pull, not just with central bank governors or central bank policymakers, but also with governments that have been issuing, the question of supply, bond vigilantes, all these themes I think will continue and persist in 2024. We had the debt brake news come out yesterday out of Germany. And really, we've come, last year we've had a lot of these instances where the market has really pushed back on those plans of fiscal spending from governments, whereas the monetary policy aspect of things is really focused on, as Paul says, that inflationary and backward-looking view. Now, yes, inflation has been easing, but you do find that there is some persistence in it that is quite concerning for central bankers, particularly as they've waged the most aggressive tightening cycle that we've seen in decades. And so to walk back on that so soon might seem rather, unpriced or mispriced for those policymakers. And so they want to make sure that inflation is completely in the rear-view mirror before they have to go on and look at things like financial stability, which is very much an important mandate for them. And we've seen them react, whether the Bank of England or the Fed. We have seen them react from the SVB to the LDI fallout that we had last year. So I do find that central banks are still in a very tricky situation. They're not responding to, and they're not here to close out spreads, right? As that famous line that we've had from the ECB, they're here to make sure that their mandates are fulfilled, and that's the inflation and the financial stability target, and that's going to continue to be a theme into next year as the market fights back on that.
Nora, thank you so much. Nora Al-Ali, and we'll be back with Paul Donovan, Global Chief Economist at UBS. This is Bloomberg. Welcome back. Let's talk banks and let's turn to Barclays. A Reuters report saying the bank is working on a cost-cutting plan of up to £1 billion. Now, an estimated 2,000 jobs could be on the line. For more, let's get straight to Bloomberg's Tom Metcalf, who oversees all of our finance coverage in Europe. So, Tom, what do we know exactly about the proposals, and actually, is that a surprise?
Yeah, some interesting specifics. So in terms of those, they're looking at cutting about £1 billion of costs over the next several years. This is according to Reuters. And as part of that, they would say as many as 2,000 jobs would go in basically Barclays' back office. I would say this has kind of been well flagged, not hugely surprising. You can kind of see that in the share price today, which has barely budged.
So what more can they actually do?
Well, I think that's the interesting thing here is this is sort of almost like a placeholder, right? We're all waiting for this big investor event in February around full-year results. We're expecting, a much bigger overhaul. So for me, that's the kind of key question: is how much further can, the CEO and Barclays management team go? This is their first, sort of offer, I suppose, and it looks like they need to do a lot more.
Tom, thank you so much. As always, Tom Metcalf there, overseeing all of our finance coverage across Europe. Now, still with us, Paul Donovan, Global Chief Economist at UBS. Paul, again, away from the banks, this is a story of interest rates. What are you expecting the Fed to do? When you look at consumption, it seems to be holding okay, but there's this 6-month weirdness where every 6 months it feels like we're expecting a downturn, the consumer holds on, and markets reprice what the Fed does.
So I think on the consumer story, what the market periodically misses is the fact that the middle income consumer is actually in a relatively good place overall. And that's what is softening the nature of the slowdown. Now, I think there is a slowdown. It's a softish landing next year, but that implies there is some kind of landing. Unfortunately, lower income groups are not in such a good place. They have run out of the post-pandemic era savings. They are more reliant on credit in order to survive. They're facing higher rents and so on. But the fact is, if you're a middle-income household in the United States today and you own your own home, that's the critical caveat, unless you live in Florida, your inflation rate is somewhere between 1% and 2%. And so your real spending power, your ability to consume is better than the headline numbers suggest. And that's been the thing which has been, I think, deceiving the markets a bit. But the key point here is that the inflation reality is lower. And so that means that the consumer is that bit more resilient.
But how long can that stay, Paul? Is there going to be a big downturn, or do you think the consumer continue spending muddling through?
So I think there's going to be a slowdown. we are in a situation where for 2023, the consumer has been very much reducing their savings rate. So they haven't necessarily been dipping into the money in the bank. But what they've been saying is, well, we've got money in the bank, so we don't need to save $500 a month. Let's save $300 a month, and therefore spend the other 200. And that's been going on, and the savings rate has come down. Now, that can't carry on indefinitely, and we're probably coming to the limit right about now. So what that means is we need to see real wage growth come in to support the consumer. And for the first time since the pandemic, we are finally seeing some real wage growth. So that doesn't give you a collapse. It doesn't give you a slump. But the fact that you're running out of the ability to keep reducing your savings rate, that's probably going to push us below trend growth. So I think that's what we've got to think about next year. It's a below trend growth environment, but it's not desperately below trend. We're not in recession or a deep slowdown or anything like that.
Paul, is there something that, we talk a lot about productivity. We had also the autumn statement here in the UK 2 days ago. Like, what would your template be for the UK to grow? I know you were talking about the Bank of England, the fact that they have adults in the room, and maybe, they'll be upfront and cut when they need to compared to some of the other central banks.
Yes, so I think that the situation in the UK, of course, is that we have ongoing fiscal tightening. And actually, we have quite significant fiscal tightening as we go into next year. So that's obviously a fairly strong headwind to economic activity. The other thing we've got to be very much aware with, I think, with the Bank of England and the UK economy is that because of the structure of the UK, because it's an economy that sort of has embraced flexible working, it's embraced online retail and so on, there's enormous change going on in the economy. And we know the data doesn't capture this. So just a couple of months ago, the Office of National Statistics completely changed the narrative in the UK. Said, no, actually, it wasn't a weak post-pandemic recovery. We're actually doing pretty well by the standards of the G7. And they did that just by discovering growth that had previously been missing because the structural changes were disguising it. So we've got to be a little bit careful in assuming how bad things are going to be next year. But with the fiscal tightening and remember, of course, the ongoing higher interest rate saga, that is going to be a constraint. And that's why I think the bank is going to move to ease back a bit second quarter next year.
Paul, thank you so much. Paul Donovan, there, Global Chief Economist at UBS. We'll have plenty more on this throughout the day. This is Bloomberg. Now it's a week to go until COP28 kicks off in Dubai. The UN body tasked with setting up a new carbon crediting mechanism will present crucial guidance to the conference. If agreed, it would become operational next year. Now we're joined by Stafford Capital Partner Angus Whiteley. Angus, thank you for joining us. I mean, there's a lot of concerns. Some of the voluntary carbon, putting out there, like the figures were not harmonious in different countries, and they just didn't really achieve what we wanted them to. What's the way forward?
Firstly, thank you for having me, Francine. And I think it's worth just sharing some context for that question and where we're coming from. If we look at what's happened in 2023, we have had earlier in March this year, we had the IPCC sixth assessment report. We've had temperatures through the course of the summer which have been global records of extreme temperatures. And that's continued as we've had the International Energy Agency coming out with a report in September about the energy pathway to 2050. And we've had most recently in the US the fifth national climate assessment. So all of the evidence that's in place now is that we need to be acting much quicker than we have been. And we then need to look at the tools that are going to enable us to act. Your question about the carbon market and the nature of the voluntary carbon market is one in which, yes, we have...
But it's just not working. I mean, A, can it be rescued? And two, what's the way forward? Does it actually have to be not voluntary? Do you have to have regulation around it?
Well, look, we have a mix of different markets at the moment. We have voluntary and we have regulated markets. And ultimately, I think where we need to get to is to the position where globally we have a carbon price. And I think the challenge for reaching that point is that we need harmonization and collaboration across the world. And that, in today's world, is looking like a very hard pathway. So we have regulated markets in certain places, we have voluntary markets in certain places, and we have that context which I've explained, which is putting an ever-increasing pressure to come up with a solution to the carbon price and the carbon challenge. So I think there's pressure there. We need collaboration amongst countries, and I think that is something that everyone coming together at COP presents the opportunity for people to talk.
So you don't think regulation should actually look at this? I mean, it'd certainly be more decisive and, with more teeth.
Look, I think what needs to happen is that this needs to happen on a global basis. So, yes, we can have local markets and local regulators making change, and that's a good thing. But I think what we need to see is the harmony across the group.
Angus, thank you so much. Stafford Capital Partner, Chief Executive Angus Whiteley will be back with more. A four-day pause in fighting between Israel and Hamas begins. 50 Israeli hostages and 150 Palestinian prisoners are due to be released, with more aid allowed into Gaza. Germany again suspends a limit on borrowing amid the country's budget turmoil, while the country's economy minister calls for radical reform. Plus, Barclays is reportedly cutting costs by as much as £1 billion, with 2,000 jobs on the line. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. So we were talking about the carbon credit market. Let's continue that discussion, which, of course, will be one of the focuses on the upcoming climate talks in Dubai. Still with us, Stafford Capital Partner, Chief Executive Officer Angus Whiteley. Angus, we were talking a little bit, of course, about the carbon markets. And I think the overarching question is, do we just need to cut economic activity instead of paying to make up for it with carbon credits?
So let me see. I think that clearly we cannot make up for it by issuing carbon credits. I think that we need to be reducing real-world emissions, and we need to do that in a way that, reducing economic activity, I don't think is the answer. I don't think that that's the way we're built. I don't think that's the way we're set up. I think it's a question of addressing how these emissions are produced and what it is we do and how we do it. So, we've seen, I've mentioned earlier, that we've had the reports coming out about the challenges that we face. But I think there is cause for optimism for what has been coming out through these reports and to say, actually, what we've been doing well. So if you look at the electrification of, let's say, transport, for example, I think there's been huge praise as to the progress that's been made in that. And this is part of the solution. I think what we've seen is, let's say, recognition that the technologies that can address the challenge are now, I think it wasn't long ago where we were saying we need to develop technologies. Well, a lot of technologies have been developed, and it's a question now of implementing them.
So what is your big expectation for COP28? What are you hoping, will happen for carbon credits?
Yeah, so look, expectations and hopes. I mentioned earlier that bringing together, let's say, a greater alignment, the working towards a carbon price that can be established. I think if you look at the way the world is operating now, we're getting multiple different indicators of what the price of carbon can be, there needs to be harmonisation, there needs to be greater alignment, and I think that's really what I'm hoping that we can take some steps down that pathway, and we can take them quickly.
I mean, companies such as airlines have been found out to greenwashing, claiming some of the credits have rendered their products and services carbon neutral or even negative. How do you push back against greenwashing now? Like, again, how do you make sure that no longer this happens?
Well, I think, let's consider the challenge. The environmental challenge is huge. There is a financial reality to it. And then there's a broader position of encouraging change. I don't think the way of bringing about positive change is to go about looking at let's say, addressing issues, greenwashing is something that I'm very worried about, because I think it allows the naysayers to stop, to not do anything. And we can't have that. So, yes, we don't want greenwashing. Of course we don't. We want encouragement, we want support, and we need positive change. So let's make this a more positive, hopeful discussion rather than, let's say, giving greater justification for not doing things.
Thank you so much, Angus Whiteley. They're a Stafford Capital Partner Chief Executive Officer. Now, Germany's business outlook has improved for the third month in a row on hopes of an economic recovery. The Ifo Institute's expectations index hit a 6-month high of 85.2 in November. Joining us now from Munich is Clemens Fuest. He's the president of the Ifo Institute. Mr. Fuest, as always, thank you so much for giving us a little bit of your daily schedule. How worried are you about the German economy right now, given the latest figures?
Well, I think we are getting positive signs from the incoming data. So it's probably too early to say it's a recovery, but it's a stabilization. So the economy is going from contracting to something like stagnating. Of course, there's a lot of uncertainty now created by the budget chaos, and we will have to wait and see how the government handles this. But this is the big question mark, I would say, over the recovery.
Mr. Fuest, is Germany in a recession? And if so, when will it end?
I think currently our view is that the German economy is rather stagnating or stabilizing. So I wouldn't call it a recession at the moment. We think the economy is stagnating or even growing slightly. But there is, of course, uncertainty for the next year. We were expecting a recovery next year driven by falling inflation rates, maybe falling interest rates, or the expectation that interest rates may fall in the second half of the year, growing incomes. But now, of course, we have this risk of the budgetary situation, so that creates uncertainty.
But do you think we're past the worst of the downturn?
We are probably past the worst of the downturn because we think the economy will start growing slowly. But as I said, there's now this renewed risk, so we'll have to see how that plays out. I mean, if there were massive cuts or tax increases, the economy would be likely, yes, to fall into a recession. But I would expect the German government to manage this differently so that that can be avoided.
When you look at, I guess the mess of the budget mess right now in Berlin, what's your baseline impact that has on growth? And again, if there's a worst case scenario about the impasse, what does that look like?
So the worst case scenario would be that the budget hole of 35 billion is filled by spending cuts and tax increases. That would be that would have a very negative impact on growth. It could put Germany back into recession in the coming year, but it's not my main scenario. My main scenario would be that the government manages to find other solutions so that, yes, there is uncertainty, which will dampen growth a little bit, but I think we will see growth, albeit rather weak growth, something between maybe 0.5% and 1%. That would be my main scenario.
Mr. Fuest, can Germany actually implement some of the necessary changes to the economy without this, special money from off-budget funds that were now found to be in violation of the Constitution?
Well, I think the government could review the subsidies it plans. It could increase, for instance, the CO2 price a little, but it's impossible, in my view, to come up with all the necessary finding just through cuts and tax increases. So we do need deficit financing to finance the investment needs in infrastructure in the energy transition. And the question is, how can that be achieved? One way is to use public companies to incur debt. That would be legal. But the better approach would be to try and set up a new fund and anchor it in the Constitution. So that would require cooperation with the opposition, with the Conservative Party. Such a consensus was found for the Fund for the Armed Forces that was introduced after the Russian attack on Ukraine. And I think that should be repeated now for the energy transition and for infrastructure. Will the opposition agree? Certainly not in the short term, but maybe after negotiations.
Very interesting. Mr. Fuest, as always, thanks so much for joining us. Clemens Fuest, there, the president of the Ifo Institute. Extremely important given the last couple of weeks on Germany. Now, coming up, Slovenia agrees an extra levy on banks and businesses to fund the recovery from last year's devastating floods. Our interview with the Slovenian Finance Minister is next, and this is Bloomberg. Now, Slovenia's government has approved a tax on banks and higher levies on companies to fund reconstruction following severe floods in August. At least 7 people died in the country's worst natural disaster in 3 decades, while businesses, homes and infrastructure were also destroyed. Well, we're very pleased to be joined now by the Slovenian Finance Minister, Klemen Boštjančič. Mr. Minister, thank you so much for joining us. First of all, can you talk to us a little bit about some of these efforts really to reform the plans of the government through extra tax? What does that look like for businesses?
Yes, Slovenia, this year in August, the biggest natural disaster in our history happened. The consequences are severe. So just in direct cost of the floods is measured around 3 billion euros, while together with the indirect cost, this will be close to 10 billion. So it's something, I'm talking about 5% of our GDP to 15% of our GDP. After the floods, the government reacted immediately, meaning we're just actually we're in the middle of preparing the budget for 2024. So we immediately changed our priorities, basically financing the costs became the first priority, and of course, so one of the part of our work was also to try to find certain revenues which will help to find these sources. And after quite long debate with the different institutions, we decided for those 2 taxes, as you mentioned. It's additional.
Minister, the taxes were criticized, but by a lot of the people that are being taxed on. Do you worry that this will have a backlash effect, that actually it will hurt the economy as there's less investment in the country, or businesses feel like they need to spend less?
Well, new taxes are always criticized, but no. The answer is no, because we took a lot of effort, made a lot of analysis, which kind of a tax would have as small as possible effect in this regard, as you spoke. So that's why we decided for a temporary additional 3 percentage points of corporate tax and tax on the bank assets, which, on the other hand, just to explain, in 5 years we predict that from this tax, bank assets tax, we will have a little bit less than $500 million, while only the profits of the banks this year in Slovenia will be above 1 billion, which mostly contributes to the difference between active and passive interest rates, which is, of course, the case all over Europe.
Minister, the EU is also trying to push through a Ukraine aid program. What's Slovenia's position on this?
Slovenia has been one of the most vocal supporters of Ukraine since the beginning of war. Also, in the terms of funds, monetary and other help to Ukraine, we are among the top countries measured by per capita or per GDP in the help of Ukraine, and we intend to support Ukraine in the future. Regarding new financial instrument that European Commission is introducing now, we support it. We believe it's necessary because it's an instrument which will somehow give an answer to changing short-term recovery needs and mid-term modernization needs of Ukraine. And while on the other hand, which is very important, which this instrument we believe will bring additional transparency and predictability regarding the funds needed.
But Minister, so what happens, would you be supporting an alternative aid program if Hungary actually vetoes a program for 50 billion?
Yes.
100%? No.
No, from what is known by now, this is quite in line with our views and the way how Ukraine should be helped.
Minister, how much do you worry about fiscal indiscipline and growing debt in some of the largest countries in the EU?
Very much. I mean, after 4 years of escape clause, which means that the fiscal rules would put on hold after the pandemics and energy crisis, of course, and a lot of helicopter money distributed in Europe, the governments, the ministries, the people got used to it. And so it's very difficult now to change it back to the situation we were before 2020. But it's clear that it's the end of this escape clause. So the new fiscal rules should be back. In the case of our country, we have written the fiscal rules in our constitution. But of course, these are the old fiscal rules which don't answer to the current situation anymore.
But so, Minister, so what are some of the proposals on the table? And actually, which proposal do you think has the best chance of being agreed on?
Currently, we are talking regarding first special deficit safeguard, which will somehow require from the member states to bring the deficits well below 3% threshold. The second one is the debt reduction safeguard, which is being kind of written in a new way. The third thing, which is very important, is regarding the debt sustainability analysis, which is probably a new working team will be formulated to additionally analyze this procedure, which is, in simple terms, a complex system which gives the results very different from one country to another. What should the goals of the countries be? Fourthly, most probably the defense expenditures will have a special status regarding a potential opening of excessive deficit procedures. So these are the basic questions.
And do you think there's enough agreement to actually find a consensus and sign off?
First of all, I'm quite sad that a lot of valuable time was wasted during last years and months. And I was very vocal also in last year at the ECOFIN meetings regarding this. On the other hand, the Spanish presidency, especially Minister Calvino, is really trying to find a consensus. So I really appreciate all the efforts they're doing. Of course, there are big differences in views of the countries, but on the other hand, all the ministers of finance agree that we have to find a compromise to a sustainable finance in Europe. So although it still seems difficult, I have no doubt that there will be a compromise in the next few weeks or months.
Minister, we were talking about the floods, and of course that means that because of your budget, you're not in line with the fiscal rules and you've been granted an extension. Are you confident that you will meet that extension, or do you worry that some of the reconstruction plans will cost more than expected?
Like I said, the priorities of the government, of course, shifted because of the floods. Our goal, and we've been very clear about it, our goal is to try to reconstruct all the areas as soon as possible. We don't want to go into the position where the restructuring will take 30 years, which was the case in a lot of natural disasters. On the other hand, the discussions with the Commission regarding the so-called one-off effects of these floods were successful till now. Just this week, a couple of days ago, the Commission introduced their statement on the draft budgetary plans of member states, and Slovenia is among 7 countries of Euro area where the Commission agrees that our budget for 2024 is in line with the recommendations of the Commission.
Minister, you also planned, I think, to issue some bonds in China and Japan, and I think it was meant to be in the autumn. We haven't had that yet. Is it postponed or cancelled?
No, I believe that our treasury is the best in Central and Eastern Europe, very professional. And basically also the question of issuing a bond in Japan is still very alive. Most probably we will issue it next year. The reason why we haven't done it this year as we thought a year ago is basically mostly because of a very good liquidity and cash position we have today. And secondly, we try to bring the deficit at the end of the year below the 70% of the GDP. Yeah. So that's why we decided to move it to next year. We are still not, we haven't decided regarding the China, but we are exploring this market as well. But all this is just, we want to explore all the possibilities and to be prepared if any other new financial crisis arises. And I think that's why it's important to distribute the risks.
Minister, thank you so much for joining us today. That was the Slovenian Finance Minister, Klemen Boštjančič, joining us here in the studio. Coming up, retailers get ready for Black Friday with big discounts. Will consumers spend big or stay at home? We have all of the deals and the trends and the details next. This is Bloomberg. So it's Black Friday on what retailers hope will be a big shopping day. A GfK survey has found that consumer confidence in the UK actually rebounded in November. Let's get more now from Bloomberg Opinion's Andrea Fjellstedt, who of course covers retail and luxury very, very closely. Andrea, so good to see you. So how important is Black Friday to retailers this year?
It's going to be very important. I mean, it's always important. Now, I think it's going to be very mixed. PwC actually thinks spending will be down this year in the UK, £5.6 billion compared to £7.1 billion last year. I think consumers will shop, but I think they may shop in a different way. Other surveys have found that consumers will shop, but they're going to look for gifts. They're going to look for essentials. They're really going to sort of stock up to do their Christmas shopping or maybe buy things they would have bought anyway for a cheaper price.
So what are we expecting from online sales? They feel, wider and deeper than usual.
Well, I think, online has suffered, so you may see some more online deals. I think the deals generally, this time last year, everybody, the UK, Europe, US, had this mountain of inventory that they were trying to work through. So I think that has been largely worked through. But there are pockets of probably oversupply. So if you're in the market for a coat or boots, we've had a warm autumn. That's pretty good. Fashion, I think, will be very mixed. There's an awful lot of sequins around. I'm not sure people will buy that many sequins. Could see some deals there. Electronics as well. We could see some deals.
Okay, interesting. Andrea, thank you so much. As always, Andrea Fjellstedt there from Bloomberg Opinion. You should definitely check out everything that Andrea writes. It's always interesting and a little bit different, too. Now, this is a picture across the board. You look at markets. A lot of the focus is not only on inflation, but it is on the German economy. Now, we had a great conversation with Clemens Fuest, of course, of Ifo. European shares wavering after the latest economic data highlighted Germany's struggling to recover from an energy-induced downturn last winter and the impact of higher borrowing costs. We'll have plenty more markets next. This is Bloomberg.